Hello. In this video, I'm going to show a little bit how you can, after you are already done with your forecast for your income statement, how you can deal with your balance sheet and cash flow. Right. So I'm going to be using this example here, which is the one I use the most because it's simple and everyone can understand, which is from this e-commerce company. And if I go in here and this can be applicable both if you are using a template or if you're using QuickBooks or zero integration. So any of them work, right? But if I go here, for example, to our income statement, you see that I already have some values. I have some forecasts here and some projections. So I've already done the work of forecasting my income statement for this project. And now what I'm going back to is going back to the console. I'm actually interested in the cash flow and the balance sheet, right? So first things first, let me explain a little bit how our balance sheet and our cash flow work, and then what you can do with them. So starting with the balance sheet, um, usually the off-the-shelf balance sheets in Fluxo are quite simple. You can see all the assets here at the top, and then you can see the liabilities and equity at the bottom. Um, they should usually match, especially for the actuals. Um, and if they don't, it's probably worth investing a little bit of time seeing what is the problem, what is the account that is either missing or is erroneous here. But given that our balance sheet matches, what you can see is that in each of them, you have usually, some big uh, line items, right? So in this case, for assets, you have banks, accounts receivable, and so on. And then for liabilities and equity, you have credit cards, accounts payable, and so on. This can vary based on the type of integration that you have or the template you're using, but the logic is always the same. So that's what I'm going to be focusing on. And the other thing to um, keep your mind on is that usually these accounts, like the balance sheet here, is using formulas and referencing lower level tables, right? So for example, you see banks here, you can always click on the formula and see where things are coming from. And the way to read this is coming from the row banks, from the bank accounts table on the assets space, right? So if I go here, find the assets space, bank accounts table, and click, you'll see that I have a table here called banks with a couple bank accounts that I have and the total. And these total, keep an eye on this number here, 281,000. It's gonna match the number that I have here on my balance sheet, right? And the same can be applied to all other line items here. Okay, so this is the balance sheet. So keep this information for a moment, and now I'm going to show you our cash flow. Cash flow works a little bit different, right? Because what we do, and it's very useful to create forecasts and budgets, is we use the indirect method for the cash flow, which means we start here with your net profits, and then we look at the variances in the balance sheet to calculate all the other changes in cash flow, right? So that is super effective and a very quick way for you to see, besides your profits, what are the other things that are changing and causing some cash flow for you, right? And then at the bottom here of your cash flow statement, you're going to see you have your net cash flow for that period. You have the beginning cash, which is your bank accounts on the beginning of that period. And then you have your ending cash, which is your bank accounts at the end of that period. Okay, so that's how our balance sheet and how our cash flow work. Um, so the first thing that you need to do when you are trying to create your forecast or budget here for cash flow and balance sheet is adjust the cash, right? Because as I mentioned here, Your ending cash for your actuals should always match what you have on your bank accounts, right? But for the future, this is a formula and this is being forecasted month by month. So you actually need to build this connection on how you want your ending cash to translate into your bank accounts, right? So for example, we want this number here for April, and let's for a moment say that all the rest of the balance sheet is correct. So we would like this number here for April, 425,000, to be reflected on the balance sheet under bank accounts, right? So if we go here to the balance sheet, we see that that number is currently not reflected because we still need to do some work, right? So how we're gonna do that? We're gonna go to the bank accounts table, and basically, I mean, there are multiple ways in which you can do that, um, but usually the two most common ways that I see, especially small companies, projecting their bank accounts based on their cash flow, is either they keep one of the accounts consistent and they basically throw all the cash flow in the other accounts, or they just distribute equally throughout all their accounts, right? So I'm going to show you both methods. So if you want to just keep, for example, this bank number 2 consistent, and you want to throw all the difference in cash flow to your bank number 1, what you can do is come in here and add a custom formula or a model of the type custom formula. And we are gonna call this previous plus cash flow. And this is exactly what we're gonna do in the formula, right? So we're gonna use the self function. And what the self function does is it just grabs the number from the previous month, right? So self for April would be this, self for March would be this, and so on. So we'll do self plus net cash flow. And that is all. So you see that I updated this, and now this total here, 425,690, matches, my total here. Right? See that's how easy it is. The reason why we leave this for you is because there are other methods, right? So I showed you one. Let me show you another way you can do this, right? So remember, this first method is just, I'm basically choosing to put all my money in or out to one bank account, right? I'm gonna do something different now. Remove this. So it's gonna start now from scratch again. And what I'm gonna do this time is actually, I wanna grow all the accounts according to how my basically distribute equally the cash flow that is coming, or proportionally actually to how much money there is already in these accounts. What I'm going to use is ratio, and I'm going to say ratio to ending cash. And what I'm going to do is here I'm going to put ending cash, and I'm just going to select from the average of the last month, which means basically just from the last month, and this. So basically, I'm proportionally assigning to this row the extra cash. You see that this number is still not matching the total that we want, but we're gonna do the same thing here, ratio to ending cash, ending cash 1 month, right? So basically what this is gonna do, as you can see, is now it's going to calculate, and you can see the same number that we're trying to achieve. The only difference is that now both of these accounts are growing equally over time. And by equally, I mean proportionally to the size that they already were, right? So you can see that, from the extra cash that's coming in, 140 is going this way, 5 is going this way, and so on. And in this way, things keep balanced, right? So now when I go back to my balance sheet, the cool thing that you can see is that now the future is already balanced, right? So you see that now April total liabilities and equity match total assets and so on. So that's what you need to do first, right? So now that, okay, your balance sheet matches, so now you actually already have a working balance sheet. The next thing that you want to do is then go into the same way as on the income statement, you would go into your revenue, then expenses, and basically project them one by one using whatever logic you want, and whatever makes sense, obviously, for the business. Here, what you're going to want to do is go one by one on these items and think through what makes sense for this business, right? So let's go through, for example, accounts receivable, right? So as obvious, we can always check the formula here to see where this is coming from, but it's also kind of obvious, right? So accounts receivable is coming from the accounts receivable row, from the accounts receivable table, from the assets space. So I go to the assets space, accounts receivable, you see this is where accounts receivable is coming from, right? Um, for your project, especially if you have an integration going on, it might have some extra complexity in here. It might have like multiple line items under accounts receivable, and you might want to choose if you want to just project one of them or all of them. You can always choose. That's the big thing with Fluxo. It's all about flexibility, right? But let's say for this case, okay, I have this accounts receivable, and if I don't do anything, the projection is just that accounts receivable is going to remain the same forever. But that's not true, right? So what you can do is really think, okay, what is the logic for my accounts receivable, right? So um, there are, for example, a few ways that you can think about it. One of them is, well, actually my accounts receivable will grow, for example, I think they'll grow 5% per month or 10% per month, right? That's one way to do it. The bad thing about doing like that is that usually you are going to have a mismatch between your accounts receivable and your revenue, for example, right? Which is not good. So what you usually want to do is make the accounts receivable somehow related to your revenue. And the way you can do this, for example, is just using a ratio, right? So what I'm going to do this is say ratio to revenue. And I'm going to find revenue here. And in this case, for accounts receivable, I'm going to say, I'm going to use always the average of the last 3 months. And I'm going to use that to project the ratio of accounts receivable to revenue that I have in the future. And then I save it. And you'll see that it will change dramatically. But then when you go back, to your balance sheet, what you see is that, well, first your accounts receivable is going to change, but you'll see that your liabilities and equity and your assets still match. Why that? Because when we changed the accounts receivable, what happened was our cash flow also changed, right? Because remember, accounts receivable is revenue that you didn't receive yet. So you're going to have less cash flow if you have a higher accounts receivable, which means at the end of the month, you're going to have less cash in the bank. So when you do change your accounts receivable, actually you change your cash flow, but your balance sheet in general still matches and everything should still fit perfectly. And that same exercise you can do for current assets, fixed assets, and so on. I think, I hope this was helpful. and this can help you create um, better forecasts, a better budget for your business. As always, please feel free to comment or to let me know if you have any questions. You can always reach out to us in the chat or by email, and we're here to help. Thank you.